Welcome to the accounting class. In this session we shall take a further look at accruals. Before we start to construct any of our financial statements, we start by getting information from a trial balance. This tells us the current balance in each of the accounts. Remember, it might not be entirely accurate. Remember that matching principle? Our revenues and expenses need to be applied to the current period. What could be wrong? What is there that we might need to adjust? We usually pay our property insurance for a period of 12 months in advance. At the end of the first month, we will only have used or expensed 1 month of insurance cost. The wages for the month might not have been paid. We are waiting for the telephone bill to arrive. We have been paid in advance for goods we have yet to provide. To conform to the matching principle, we may need to make several adjusting entries. Most businesses will have prepaid some expenses. For insurance, the payment asked for is usually in cash, which includes making a payment by cheque or by debit card. There will have been a credit entry to the cash account. The debit entry will have been to a prepayment account. The prepayment account is an asset account, but as each month goes by, the asset is reduced and the expense increased. Premises insurance is expensed on a monthly basis. Unearned revenues may need adjustments. Unearned revenues occur when cash is received for goods or services to be supplied at a future date. When the first entry is made, there is a credit to a liability account. Once the goods or services have been supplied, an adjustment is required. Prepaid expenses and unearned revenues are both forms of prepayment. The opposite of a prepayment is an accrual. Accrued revenues are when the goods are supplied and we are waiting for the cash to come in. This is when we make our entries to accounts receivable. When payment is made, we have made an adjustment. Accrued expenses occur when we incur the expense but have still to pay for it. This is when we make entries to accounts payable. Then when we pay for the expense, we make an adjustment to our accounts. These are examples of accruals, and we are already familiar with the adjusting entries to accounts receivable and accounts payable when money changes hands. Let's look at a short case study. Dee runs an event organising business. On January the 1st, she pays out $1,200 as insurance for the premises. How will the transaction be entered? Our first entry will use two asset accounts, cash and prepaid insurance. Debit prepaid insurance $1,200, credit cash $1,200. What happens on January the 31st? An adjusting entry is needed. We start by calculating the amount of insurance that has expired. 1 month of insurance has expired. This is the expense that has been incurred. 1/12 of $1,200 is expensed. This is $100. We debit an expense account to show the expenses increased. We credit the asset of prepaid insurance to show this asset has been reduced. So, debit insurance expense $100, credit prepaid insurance $100. Dee purchases office supplies for $500 on January the 1st. How does she make the first entry? She uses two asset accounts, office supplies and cash. Debit office supplies $500, credit cash $500. At the end of the month, a physical cheque reveals that $200 of office supplies have been used. An adjusting entry is required. Office supplies was the asset account. Office expense will be the expense account. Credit office supplies with $200 to reduce the asset. Debit office expense $200 to record the expense incurred. There are other adjustments. One of these is depreciation. A typical example might be for a motor vehicle. D determines depreciation for the month to be $100. The methods of depreciation are explained in a separate podcast. What will the adjusting entry be? Depreciation is an expense. The depreciation expense is debited with $100. The accumulated depreciation account is credited with $100. D receives a payment in advance of $800. This is unearned revenue. How is this first recorded? Debit the cash account with $800 cash received and credit a liability account. When unearned income becomes earned income, the adjustment is made. Wages will be recorded as an accrual if they have still to be paid. When doing this, it is important to remember to accrue the employer costs as well. Debit the wages expense account, credit a wages liability account. When the wages are paid, the cash account is credited and the wages liability debited. I hope that you now have an idea of why we make adjusting entries. We are making the entries to conform to the matching principle in accounting. This is the end of the second session on accruals. Thank you for listening and watching.